Hey, this is Justin from breakintocre.com, and in today's video, we're going to talk about how to value a vacant property if there are no tenants in a building that you're analyzing. So if you're looking at a vacant property acquisition, but not really sure how to value that property, make sure to stick around for this video. Now, if you're new here, on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or do your first deal, make sure to subscribe and hit that notification bell. So if you've been watching this channel for a while or you have some experience in real estate investing, you know that commercial real estate assets are valued based on the income that they can generate. But what if you're looking at a property that's vacant right now and actually isn't generating any income? How do you actually value a deal like that? So in today's video, what we're going to do is walk step by step through two strategies that you can use to value a vacant property and value a deal based on the operating income you believe it's going to generate and the returns that you're trying to hit for your investors. So the first method is going to be the easier and quicker of the two, and that's going to be the target stabilized return on cost valuation method. And essentially what this analysis does is it allows you to back solve for a target unlevered yield on cost or stabilized net operating income yield as a percentage of the total cost of the project. So for example, let's say you're looking to buy a vacant corner property that was recently occupied by a fast food restaurant, but because of a company-wide bankruptcy, that fast food restaurant has recently vacated the premises. And let's say that you believe the location is great and you believe you can lease up the property at market rates within 6 months after acquisition. Let's also say that based on market data, if that lease was already signed with a new tenant and that tenant was up and operating, that this property would trade in the market for a 5.5% cap rate. With that in mind, as an investor, let's say you want to be compensated for taking the risk of going in, buying the property and leasing up the space, and you want to make sure that you get to a stabilized return on cost of 6.5%, a full 100 basis points above what that market cap rate is today for a stabilized property. Now in this example, let's also say that this is a single tenant building, the leasable area is 5,000 square feet, the tenant will pay a flat $30 per square foot per year, triple net, the tenant will require $30 per square foot in tenant improvement allowances, and the leasing commissions will be a flat 6% for a 5-year lease term. So with that in mind, we can calculate that that first year net operating income, once the property is stabilized, is going to be $150,000. Now from here, we need to calculate what the total cost of the project are going to be outside of actually acquiring the property. So in this scenario, we know that the tenant is going to require $30 per square foot in tenant improvement allowances for $150,000 in tenant improvement allowances total. We also know that leasing commissions are going to be 6% of the total base rent throughout the entire 5-year lease term. So 6% of $750,000 is $45,000 in total leasing commissions. Let's also assume that it will take 6 months to actually lease up the space, and we'll have some costs associated with that downtime that the tenant isn't going to be covering on our behalf, like property taxes and insurance. So we'll assume that's going to be $15,000 as well. So when we add all of this up, we get that our total project costs outside of the acquisition of the property are going to be $210,000. Now remember that our goal is to earn a 6.5% stabilized yield on cost after that lease is signed. This means that our total cost of the project can be up to $2.5 million or $150,000 in that year one net operating income divided by 6.5%. That said, since we're going to spend an additional $210,000 to actually get this space leased up with tenant improvements, leasing commissions, and downtime, we need to reduce that $2.5 million by that $210,000 number to get our total price that we'd be willing to pay to acquire this property, leaving us with a property valuation of $2,290,000. And again, if the lease up goes as planned, this will produce a stabilized yield on cost of 6.5% on your overall costs on the project. Additionally, since we mentioned that the market would pay about a 5.5% cap rate for a stabilized deal with a tenant in place today, we could assume that we could immediately turn around and sell this property for about $2.73 million or or $150,000 in net operating income divided by 5.5%. Now this is a great way to run a quick analysis to see what roughly you'd be willing to pay for the property and if the listing price is anywhere in the ballpark of what you'd be willing to pay. That said, this analysis doesn't take into account any sort of debt that you'd be using on the property and doesn't take into account any sort of future cash flows after that first year of stabilization and ultimately the sale of the property. And that's where method 2 comes into play if you want to get more detailed and granular with exactly what you'd be willing to pay for the property. So method number 2 of valuing a vacant property is going to be a target IRR valuation approach. Now the target IRR valuation approach takes into account all of the capital costs that we talked about in the stabilized yield on cost approach, but also takes into account debt and an expected sale value when you go to sell the deal. Now, obviously, this is also going to incorporate a target internal rate of return on the deal. So a 6.5% stabilized return on cost might be a good target to hit as far as a market valuation is concerned, but doesn't really tell you much about the overall returns that your investors are going to receive at the end of the day, taking into account the debt used on the property and the ultimate sale value. So the IRR allows you to set a target internal rate of return and then back solve to a purchase price that makes sense based on the assumptions that you have about your deal. So let's go back to this same deal and say that we use a 65% loan to cost loan to pay for the property when we first acquire it. This means that 65% of our project costs, which for the purposes of this example will include our purchase price, our tenant improvement allowances, and our leasing commissions, are going to be funded as loan proceeds when we buy the deal. Let's also say that we assume that our interest rate is 4.25% and our amortization period is 25 years. Now, like I mentioned, the IRR analysis is going to require sale assumptions as well. So let's say we plan to sell the property in 3 years and we assume that at that point, market cap rates may have risen a little bit to be conservative. And let's say that we assume we sell the property at a 5.75% cap rate at the end of year 3. So now if we calculate the internal rate of return or IRR on those cash flows, we can back solve for a purchase price that's going to give us what our target internal rate of return is going to be. So for this example, let's say our target IRR is 15%, which if we back solve for a purchase price that will get us to that value is $2.18 billion. Now, as you can see here, both methods produce relatively similar valuations. That said, the target IRR approach can give you a much more detailed, accurate valuation. And if you're serious about buying a deal, the target IRR valuation approach is going to give you a much more complete picture about what your overall return metrics are likely to be on the deal. But again, if you're just looking for quick math and a quick valuation, that stabilized return on cost analysis can get you to a very realistic purchase price for the first run of your analysis. So I hope that was helpful if you're looking at a vacant property right now to acquire, or you're going to be looking at vacant properties to acquire in the future. Now, if you like this video and want to see more content like this, make sure to let me know by hitting that like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.